news, then we get good news, then we get bad news. And that's actually reminiscent of an economy that is in transition. The question is, are we at 2007 levels or 2011 levels of transition, where we're just sort of like, oh man, that was a crazy recession we went through in 2011, right? Maybe again in 22, until they changed the definition. Or are we about to go into the pooper doopers?
Okay.
Challenger job cuts report that just came out this morning indicates that layoffs for October were the highest since 2003. We need to talk about that, but we also need to talk about a hidden detail that nobody's going to talk about because it's buried in the report and it's actually potentially more critical. But let's look at the headlines first. So, October's pace of job cutting was much higher than average for October. It's really odd to see these kind of large cuts going into the holiday season. Now, of course, Amazon defends this, for example, with their layoffs of 14,000, which are part of this, obviously, I at least presume, by saying, oh, well, this was just sort of like the corporate layer. We're not we're not firing people that we need in like the seasonal retail division. We still want to sell to consumers, which I, still think is a little questionable. Why not then wait till like January or February? But whatever. Job cuts surpass 1 million for the year, highest total since 2003. Mind you, we also have the worst October, not only since 2003, but what you're about to see is the worst since 2008. So again, I'm kind of like, ugh. Total job cuts for the year.
Okay, I do a little breakdown here on solar stock. What the hell? Why? Obviously, I want 2025 earnings. Obviously, is what I wanted. Oh dear. Oh no, it doesn't have Q3 earnings. Oh, killing me. Okay. Okay, so we'll take the earnings from that one, and then over here we'll say find similar tickers to Sedge. And then we'll also say talk Sedge recent news. That should be something to work with here. Okay, so it does have the Q3 earnings now. Revenue was 340 million, exceeded consensus. Yeah. European revenues are at 100 million. Okay, we're just going to jump in here. The stock will surprise everyone. This is Solar Edge, right? I think that's what it's called. Yeah. This stock will surprise everyone. The lighting's a little messed up here. No, it's just me. I'm just an idiot. All right, that's fine. Nothing like multiple fake outs. If you're on YouTube, I can see your comments over here. So that could be cool. going to repeat that so I can see those comments. And then, yeah, we'll get cooking here. This stock will surprise everyone. This is not financial advice, but my research suggests people who buy $50 of this before November 15th could do well. The stock is Solar Edge, SEDG is the ticker. They recently had Q3 earnings, $340 million of revenue, beat consensus. Just over 100 million of that coming from European revenues. So that's up almost 50% quarter over quarter. Very fast overseas growth, which is encouraging if, for some reason, solar doesn't end up being the energy source of choice to power all the data center build out. There is major growth in Europe as well. So a little bit of diversification for this company in case there's diversification among energy sources. Again, this is not financial advice, but let's jump into a breakdown on Solar Edge.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
So first off, this is the chart. And so this is unusual to talk about a stock where the earnings is so good, but it just brings it up to a level that already existed. So it had been selling off before earnings. So that's kind of indicative of the earnings being a surprise, right? Sometimes you see good earnings being prefaced by buying. Look at the buying into Apple's earnings, which were solid. Amazon, same situation. So it's a little unusual to see a move like this. And it's holding up. So this actually is being received well. Now, it's gone on quite a run, but it's only a, under $50 stock. So it's reasonable to see it, almost triple during a period of about 6 months when we're talking about an under $50 stock. So here's the earnings. There's the earnings per share. Loss was less than expected. And let's jump into a little bit about the earnings so we can dot our T's here, cross our I's. There's the revenue exceeded analyst estimates, almost 20% increase from the previous quarter. Gross margin improved from the previous quarter. Net loss improved from the previous quarter significantly. So this is a little company, right? It's a startup that's publicly traded. And with these companies, you do want to make sure that they have some institutional ownership, particularly in biotechs. It doesn't matter as much with companies outside of biotech, but if it's a high institutional ownership, that can be, a good sign. It's not a bad sign. I'll say that for sure. And we don't have to worry about dilution too much. So that's good. The market cap may be the reason for that. I'm not 100%. I think this tool does carry, especially if a small market cap runs up quickly, it'll carry information about a dilution. The market cap alone being like 2 billion isn't in and of itself reason for dilution not to exist or not to matter. There are certain cases, like some of these quantum tickers have raised, this is a $10 billion market cap, and they've raised like $1 billion. I mean, maybe not RGTI. I mean, 350 million is a lot. And then in one raise, and then IONQ, there's $1 billion, right? So dilution definitely can matter. I mean, to raise $1 billion, you have to do it. You can't just sell shares into the market to do that. At least, I mean, maybe you can, but it would really depress your stock price, I would think. Like they can only raise $500,000 with their, and this is from 2 full years ago. So they'd be unlikely to use this in a short period of time of a couple days, few days. So all this to say, it's useful to know that Sedge is not super hinging on a dilution in order to raise money. They are, having a loss, but it's improving, and revenue is improving. That European revenue is improving right here, and this is a notable award. I'm not going to explain to you what the inverter market is because I don't know what that is, but I have heard of it. I think they are definitely in the conversation with the biggest solar companies in the world. And these are the solar companies right now we're talking about. Enphase, so that's, I guess, their main competitor. First Solar, and then the Canadian one, as well as, I guess, Sunrun as well. I don't hear Array talked about as much, but again, not in the industry. So what I look at is I look at how the charts are shaping up. And First Solar looks great. It just seems a little bit hard to get into right now. Maybe after this sell-off, there is a place to get into it, but I more so just mean, in general, it tends to channel. So for that reason, Sedge a little more attractive. Enphase, right? Just yucky. And Sunrun, this earnings reaction is pretty ugly. We can see exactly day by day how that went down, but down in after hours and then continuation sell. Like a mini meta, right? And for completeness sake, here's CSIQ. Crazy run, but earnings coming up. Can't really touch this right now after like 7 green days in a row. Can't catch them all. I did not see that coming. Although, yes, of course, in hindsight, everything looks great. And then Array is the other one to take a look at, see how this earnings reaction holds up. So that'll help make sure, give you confidence to hold Sedge. So this is the line right here. It's literally at that line, and that's the idea, SCDG. If you like these ideas, hit that like button. If you want a free course on how to buy stocks before they go up, hit that subscribe. I post that in the YouTube posts. And if you want to get one-on-one help, head over to stockscommunity.com. I'll see you in the next one.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
Alrighty. See what else Kevin's got cooking here.
Here are at 1 million. And October's pace of job cutting was much higher than average for the month. Some companies are saying they're correcting after the hiring boom after the pandemic. But this also comes as AI adoption and softer consumer spending and corporate spending, as well as increased costs, are leading to belt tightening. And I actually like the jade here because I kind of think this whole we just hired too much after the pandemic is a nice excuse that's relatable because people are like, yeah, it was like there were a lot of companies were hiring because it was hard to find employees. But let's be real, when you've got increases in costs from inflation and you've got tariffs, somebody's going to take it in the margin, and usually it's the corporations that go, crap, we can only take so much. I mean, if you look at the ISM and PMI reports yesterday, what you end up finding is the companies are saying costs are still going up. McDonald's is like, costs are still going up, but we can't pass them on to the consumer because people aren't paying. There's no PP. There's no pricing power.
Little PP.
So this is normal. We expected this to happen. Kava, Chipotle, they're all getting wrecked. Malls, I mean, these are consumer-based. McDonald's is complaining about it. McDonald's is trying to pitch you a 99-cent coffee every day to compete against Starbucks. Starbucks is selling off their businesses in China because their China bet failed. And this mall I went to yesterday, I love this kind of research, by the way. I went to this mall yesterday. It's called the Thousand Oaks Mall. And what was remarkable is the business just sold to another company, and I looked at the earnings call for the company that originally owned it, which is ticker symbol MAC, a mall REIT. And I'm like, how come this mall REIT is saying in their earnings call that they are 94% occupied, when I'm like, bro, I'm walking through this, I'm like, that's vacant, that's vacant, that's vacant. Yeah, we got an entertainment, thing that they kind of threw in here, which doesn't look anywhere as nice or cool as a Dave & Buster's, and it's dead. In fairness, it's a Wednesday evening. But you kind of go through some of this other stuff, you're like, oh my gosh, that store's vacant right there. You walk down, it's like vacancy, vacancy, vacancy.
Had to take a look at that.
Vacancy. And you're just like, bro, what's going on? I mean, it's no surprise malls are dead, Amazonification or whatever. But I'm like, hey, on your earnings report, this is another angle from upstairs. On your earnings report, Mac, you guys are like, oh yeah, we're 94% occupied. And I'm going through it, I'm like, no, you're not. And I'm like, I don't know, maybe the average everywhere else is that you're 100% occupied everywhere else. So I go through the earnings call, and it turns out this business is actually selling off their assets with the lowest vacancy. So this particular mall was included in their earnings call.
Okay. Let's jump in a little breakdown on Valera, VLO. What does this company got going on? Let's see if I even got the right earnings here. I do not even have the right earnings here. Get VLO Q3. It's just incredible how it doesn't get the recent earnings by default. So definitely a positive reaction. And then see what they got for connections to big companies. This BlackRock thing did not go through. Southwest. Airline fuel. That's crazy. Oh, SAP helps them. It's just, how did this beat? BlackRock deal did not go through, but the earnings still beat. Okay, $1 billion. Earnings per share well above consensus. Refining income almost doubled. Positive but weak correlation with crude oil prices. Ah, boy. Even if crude falls, demand for fuel falls, margin didn't improve much. Okay, whatever. They had an earnings beat. The chart looks good. No, their revenue's down. The refining revenue is up. Yeah. Oh, this is painful. I hate looking at oil companies because I have no idea what they do. Where did I see that refinery thing? Oh boy. Boy. Why is my mind going blank on this one? Refinery segment operating income tripled. How did refinery segment operating income triple from last year? Okay, that's what we're talking about. Okay. Breakdown time. Trump's energy stocks will help you retire. Make more money. This ticker is Valero, VLO, and since last year, refinery operating income has tripled from about 500 million to over 1.5 billion. Now, how they did that is miraculous. They're selling all their gas and they're able to basically refine it at a very high margin as well. So improvements on the actual product side. I don't know what I'm talking about when it comes to oil and gas companies, but I do know this chart looks great. That is a huge increase, tripling operating income. And the connection to Trump is really that this company in 23, 24, 97% of their contributions through their PAC went to Republican candidates. So it's safe to say this company is in the good graces of the current administration. It's VLO. Let's jump into a breakdown.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
So, yeah, here's the big news. There's the Trump connection, 90% contribution to Republicans. And then as far as that, earnings, I mean, we can see on the chart that the earnings is great, but I think this is a big deal. I mean, that's a huge difference. That's literally tripling. So if we look at the chart, we see that it's holding after this earnings jump, and we have another leg up, and now we're getting into a relatively important level. I mean, this is all the way back in March of last year, and we might hit that again. So first we have to get over this spot right here, okay? But this holding is really important. So if we look at other earnings reactions, right? Here's Datadog. It just started, okay? So it's holding on day one, which is a strong vote of confidence. A lot of companies, I purposefully wait for the candle to close. This is day one, actually, right here, because it opened in the morning, not in the after hours. But if we looked at some other ones, Microsoft is in the after hours, right? So this is where you would measure day one. And if we look at earnings reactions such as, I don't know, I guess Apple would be an okay example of what I'm talking about here. So you need to wait for it to close because look, the earnings reaction went up and then it sold off to a level where it started. So that's kind of why patience is really helpful here. I see it's still holding that level. So if we look at Valero, it held that level, and we can look in here to see it more clearly. Held that level right here in the after hours, about 172 and change, somewhere in here, and then held up and broke out over it. So that's still a spot to risk off of, but this strength is really encouraging. So that's the technicals of to why this is interesting in the first place, and then how they're able to get earnings that are interesting. Well, if they're using all of their oil, aka selling it, that's a pretty good deal. And then there's also, the question of, hey, how were they able to get this tripling, right? Seems like a pretty big deal. Operating income up $1.5 billion compared to $565 million. And the throughput went up. That's a serious increase. Margin per barrel. So engineers or oil specialists could tell you how they were able to do that. But I don't think it's something particular to this period in time. I think it's some type of technology. And then how much they actually refined increased significantly as well. So we could dive into this in detail. But yeah, this is sort of important is there going to be less people buying their gas? That's sort of what oil traders do every single day. And then is there anything about, supply that could change it as well? Are there going to be other companies that are providing more oil on the market? That's like specific to the amount they're generating. And then as far as just the price of oil in general, this is also notable as well. So positive but weak correlation with crude oil prices. And I mean, we can just look too. If we zoom out, maybe it's a little more clear as to how this is kind of, but not really actually helpful. So that's VLO. And then if we look at crude oil, I mean, it's tough, right? To see some type of correlation, right? Connection. Like June went up and then deep fall June 22nd. So if we look there, June went up and then fall June 22nd. Like it does have a change. That was pretty, did you see, if you can go back to this video and just see that message from Schwab? That's like preserved in history. This is like a moment for the ages. No pattern day trader flagged anymore. So that is like, there is nothing more, endemic or whatever the word is about this administration than no pattern day trader. And if you don't know what that is, someone in the comments will say it, but That was like a moment in time. I'm glad that was captured on video. But last note on VLO, the level's pretty clear. The correlation we just saw, it does affect the price, but it doesn't affect the overall trend. So we can just basically ignore that, which I know is crazy. You know, I'm talking all over the place about, you know, macro oil prices, supply and demand. I obviously don't know what I'm talking about, and that's because it doesn't matter, and we can see that on the chart. The way I buy these is solid earnings reaction, and just like this is GM or whatever kind of company, you know, you risk the top, the earnings close, and then see it go up. So that's the idea of VLO. If you like these ideas, hit that like button. If you want a free course on how to buy stocks before they go up, hit that subscribe. And if you want to work one-on-one, head to stockscommunity.com.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
All right. Let's jump into a little more Kevin here.
Oh yeah, we're really grateful. We're disposing of the following assets, and they go on to list a bunch of malls throughout the country. And I'm like, wow, that's how you guys are doing it. You guys are paying off debt by dumping your crappy malls and letting other people try to pick them up and flip them. And now I'm looking at the people who are trying to flip it, who've owned it for, you know, a few months now, and I'm like, bro, this ain't going well. You know, you may have thought you were getting a good deal. You may have just bought the bag. But point is, like, there is true weakness in the consumer, and this is why everybody talks about the K-shaped recovery, right? And the question is, like, where does this put us in the cycle? And this is the part that makes me nervous, because look at this. This is the part that doesn't get the headlines. Y'all know AMD just reported earnings, and right after earnings, the stock was down like 4.7% in the after hours. It was nuts. Now, so far in the overnight, it's recovering, and hopefully it continues to recover tomorrow. But the question is it a good buy at these prices? And this is where what I like to do is jump into investing.com. They're a sponsor of the channel, and I'm super excited about it because if you get the Investing Pro Plus subscription, you can get a bonus coupon if you use code MEETKEVIN. Just use the link in the description down below or scan the QR code. You get 55% for the Black Friday early bird special, plus an extra 15% when you use my coupon. But here's what I love. Number one, I'm going to watch EPS revisions after these earnings, okay? AMD only gets like 46% of their revenue from data centers. NVIDIA gets like 88% from data centers. So I want to see that data center revenue really butter out those OpEx expenses, operating expenses at AMD, increasing their margin, which they beat top line.
Okay. March, IBM announced collaboration with NVIDIA to integrate their data platform, supporting NVIDIA hardware. And then as far as the earnings, software, infrastructure, and AI. Did they have AI? AI book of business is almost 10 billion. Okay. So let's jump into a little breakdown. They use NVIDIA chips. They also have their platform embedded in, they're integrating NVIDIA's platform into IBM's platform. I mean, God knows what these companies are doing. Slower growth in some cloud, blah, 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 blah. Revenue is up 10%. Sure, we love ChatGPT's tables. Almost 10 billion in AI book of business. What is that? What is AI book of business? Yeah, like what is that? What does that mean? Software infrastructure and AI. So what software and AI revenue are they actually getting? What products do they have? How is this different from a few years ago? 10 billion of AI revenue. AI automation, hybrid multi-cloud plus open source infrastructure. IBM and mainframes. So IBM mainframes are on-prem. Is that right? %59% growth in IBM Z. Okay. So this is IBM 307.90. This $307.90 stock has crazy potential. NVIDIA chose them. The NVIDIA connection is NVIDIA GPUs are used by this company. NVIDIA data platforms are also integrated with this company's software. The company is IBM, ticker symbol IBM, and their infrastructure business, so where they actually have the mainframes, like what you maybe think of IBM as having, like the on-premise, like think big banks in New York, they just have like stacks of servers and they can't use the cloud because there's security issues. IBM is having significant, like 50% plus growth in that mainframe category, again, that on-prem category, and they're able to have AI algorithms on those servers. So they're able to have about 10 billion almost revenue from AI-based installations, which is huge for them, even as such a big company. So it shows that they're here to stay. And what do you know? Companies still want security. So blue chip stocks, if they adapt, still have a place. It's not financial advice. Let's jump into a breakdown.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
Okie doke. So IBM is the company, and this is some points of what I'm talking about. So on-prem is their big growth center, but they do have a hybrid solution as well for maybe less secure data. Because if you're just, installing stuff, it's kind of a service business thing, which IBM has been famous for, no one got fired for choosing IBM. But they're also trying to cross over and have some cloud growth, which cloud growth was not great in this earnings. But if they can take that high reliability reputation and then move some of those clients ultimately to the cloud, leveraging that trust they already have, that's a big deal. So yeah, production mainframe workloads typically reside in the actual hardware, right? So particularly when there's security concerns. But they're trying to turn into an AI company. I mean, they were the AI company, right? They were the first AI company, right? They had Watson. It's just that they basically got left behind a little bit, I think, when, Meta, NVIDIA, I mean, obviously they didn't have the consumer LLM. They missed ChatGPT. But did anyone really expect IBM to come out with ChatGPT? So here is the earnings, and the reaction was ugly at first. the earnings per share did beat, but popped right back up, and then crazily, a massive day, and it's holding that day. So another sort of unusual earnings reaction, but as always, where it closes, if you can find a close to risk off of, this is the best thing. And I know it might be annoying. No one likes looking at someone else's charts, right? It would be great if I was just always talking about what they do, and maybe I could just use like a chart like this on ChatGPT or Google, whatever. But the fact is, some of these little nuances do matter. Like this chart is not, it's just not instructive. Even on a 1-day chart, it's just very low resolution. This is very low resolution, even on a 1-day chart, of course. It's just ugly, but we can kind of see what's going on here. 27th and 7th are the spikes, and there's the 27th and there's the 7th. So once it breaks over here, sure, people are going to want to buy it. But in my opinion, the reason this chart is so helpful is you see the nuance, which is don't buy the breakout. Like, don't be the sucker. In my opinion, get it close to this level, risk off of this level, which is 3.0. This close, actually, we can see it up here. Precisely, it's 307.5. But, call it $308, which is where it's at. Buy it if there's a little bit of a move up, and then risk $308. That's a way to buy it. And you can see that pretty clear here. Basically, here's the close right here, $308 and change. If this gaps up, okay, maybe you buy it here. Don't love buying a gap up, and then you risk 308. If it just goes sideways, then you have the optimal way to do it. You just buy, risk very little. And if it gaps down, give it a shot to come back up. So that's a lot of technical mumbo jumbo details to try to get the most optimal entry, which I know would be great to just talk about everything IBM does, just hype them up. But in all honesty, I think that technical bit is the most important thing. Picking a level that makes sense. As for why they're doing well, they're obviously in bed with a ton of big enterprises, Fortune 500s already, right? So everyone is trying to buy AI right now. All these enterprises are trying to spend in AI because they have mandates to from their executives. Now, that could change in the next 18 months. There could be a bit of a freeze if they realize they bought a bunch of like graphics software that's like generative AI that's useless in terms of making money, right? But until that happens, that AI spend is going to continue. And the earnings reflect, that spend is great. And also IBM, I'm being a little facetious. They're not generating pictures of animals or something. They're actually doing business to business, data analytics and stuff like that with AI, which is less talked about part of AI. But this is the big deal, is that the cloud growth segment is down a little bit. So that's what they need to really be competitive. But despite that, this $9.5 billion, this is a big deal. So they are an AI company, and I think that led to a lot of the increase this quarter. So that's the idea. It's IBM. If you like these ideas, hit that like button. If you want a free course on how to buy stocks before they go up, hit that subscribe. And if you want one-on-one help for $25 for 7 days, head over to stockscommunity.com. I'll see you in the next one. And as always, I don't respond to comments usually. I do respond in the community.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
and bottom line margins. So I want to see EPS revisions, and then I want to see this change over time. Because if I take the forward earnings, which I can get from here, which is great, and I could look at 26, 27, 28, 29, 30, I calculate this at under a 2 peg, which to me means there's more upside for this chip designer, absent of course a credit crisis, a liquidity crisis, or a labor recession. Duh. But these were great numbers, and the fact that it's selling off means maybe there's a buying opportunity. But what I encourage you to do is explore the functional tools that the Investing Pro membership gives you, including the latest insights on the actual stock, their Warren AI product to help you understand the technical momentum indicators, and also the fundamental facts about the company. You can add it to your watch list, track those earnings revisions, watch what actually happened with earnings, EPS beats.
The 2 peg. I don't know what the peg is, but Kevin really likes the peg. It's impressive that Bloom is worth so much right now. This is the level for sure. So I think this is the only company that's like able to provide power at a certain voltage or something to data centers. Okay. They deploy solid cell fuel systems. This is the piece of information from this wizard guy. He's literally a wizard. He's in a book. There's the book. Oh boy, this is going to be a pain to look through. Can we do that? Boy, this is painful. I don't know how to navigate Twitter. Someone help me. At Chris Camillo, blah, blah, blah. Well, gonna give up on that, but yeah. They basically have fuel cell stacks that generate electricity, convert fuels into electricity. Solid oxide fuel cells, fuel into electricity without combustion. All right. This one stock can change early buyers' lives. This one stock can change early buyers' lives. My research suggests, it's not financial advice, but that it could be smart to buy as much as possible before November 15th. The ticker is BE, Bloom Energy. The stock is up a lot. Now, it's important to say why it's up. What they do is they have solid oxide fuel cells. So a fuel cell is a way to basically make power from fuel. So they get that fuel from like biomass. I guess like wood chips would qualify. But also, you know, I think some type of oil. And they convert that into electricity. And their connection apparently is the only connection that goes directly into how data centers are being built right now. So you can't just build a new power plant tomorrow, right? But you can convert biomass into electricity with one of these like mobile fuel cell basically contraptions, and then pipe that into a data center that you can build in about 6 months. I guess that's how fast Elon seems to be building them. So it's not financial advice. The ticker is BE. Let's look at recent earnings and unpack what this company is doing.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
So here is the stock. There's the earnings. It's holding on that earnings. And obviously this looks crazy to talk about buying this company up here on a 5-year. But look, I mean, you could have bought it. It was down at 20 and then it starts flagging at 40, and you're like, it's too much. And then it goes up to, 60 is kind of an opportunity. You don't buy that. It's like, that's too much. And then, little pullback, but goes up to 90. It's like, that's too much. And now it's up at 140. You know what I mean? So it's like, you want to say it's up too much, tell that to people who bought Palantir and then sold early, right? Or didn't rebuy. It's like price to earnings is not how companies are valued in the market right now. The speculation bucket of companies, which is this companies that are most volatile and are moving a lot. It is what it is, So I'm just looking at what is actually going on. And this is the positive earnings. This is the level around 135. And over that level it's very close to over that level. You can see the high is 138 over here. This high is 139. So it's pretty much, effectively the same. So you can buy over that level, risk that, and you get very low risk with high reward opportunity. So that's the spot. And then this is what they're up to, right? This is a kind of a janky picture, but who am I to complain? ChatGPT generated it. So hydrogen fuel cells, and they take that energy and put it into a AI data center. Right? Sounds dumb when I say it that way, but they convert fuel into electricity without combustion. Simple enough. So that's important because you don't have to overload the grid. So a lot of people are worried right now, like, my electricity prices are going to go up. It's like, well, not in this case, actually. And so you need a lot of natural gas, biogas, hydrogen. You need that, but if you can truck it to these data centers and then have Bloom do the conversion, that's way faster than actually using a power plant. So that's pretty much the key. And this company is massively important right now because power is so important right now. So it's kind of having a moment. These are also clean, which I think a lot of the big tech lords are going to be happy to say that they're providing clean energy into their, LLMs. It's just going to go well in the PR boat, I think. And then distributed energy is what this is. It's just another buzzword for this, but this is kind of a whole class of energy. So if another company, gets hot that also does batteries, there are some battery companies, QS, SLDP are actually heating up right now. QuantumScape, SLDP is solid power is what it's called, but the charts look great. All this distributed generation, that's what it's going to be really important when it becomes clear that we can't just build a bunch of power plants immediately to fulfill all of Sam Altman's needs, right? So this is the company, Bloom Energy, and then as far as the revenue, this is the earnings. 500 million in revenue is 50% increase, 60% compared with a year ago. So that's significant. Product and service revenue up kind of about the same versus a year ago. And then gross margin slightly up as well. So very big deal to have a positive operating income from a loss. Whenever you have these turnaround stories, you get huge moves. Another recent one was Hertz. The earnings per share was expected to be negative. It's actually positive. So we'll see what happens here. This one is a little choppier. Obviously this is a totally euphoric chart, but similar kind of story compared to a year ago, at least. And then, I don't know about other information about this company being that important, but I think you just do need to make sure that you're not looking at these analyses, okay? Because these analyses would completely miss Palantir and companies like that. So if you're looking for the next Palantir, Don't be looking at discounted cash flow models unless you're trying to hold it for a year. And that's not at all what we're trying to do. So this goes in the same category of like analyst upgrades or downgrades. Like if there's new information that leads to the upgrade or downgrade, great. If there's not, just ignore it, in my opinion. So that's the idea. If you like these ideas, hit that like button. If you want a free course on how to buy stocks before they go up, hit that subscribe. I post that in the post section once a month for subscribers. And if you want one-on-one help for $25 for 7 days, head over to the Discord. You'll see some testimonials there as well. So the market is in a choppy spot, but it goes month to month. September was on fire. Not financial advice. Hope it helps.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
A little bit more Kevin here.
Beats, revenue beats, you name it, guidance, take it all from investing.com. Just use that link in the description, support the channel, support the sponsor of the channel. Go to investing.com and sign up for that Pro Plus subscription. Use code MEETKEVIN to get an extra 15% off. So thanks again to our sponsor, investing.com. Early Bird Black Friday. Save 55% on the Investing Pro or Pro Plus subscription, plus 15 extra % off if you use my code MEETKEVIN. This is the part that doesn't get the headlines right here. Not only did individual companies announce large layoffs in October, but a higher number of companies announced job cut plans. This is actually a red flag that is not going to get the headlines. Job cut plans are basically like, hey, yeah, like we haven't announced the job cuts yet, the layoffs, but we're going to. And Challenger tracks this as well. And they found that there were nearly 450 job cut plans at companies. That's up from 400 in September. And it is the next.
Okay. Lemonade revenue beat consensus. In-force premium grew. And then they raised guidance as well. Investing.com, that's what we were just talking about over here. All right. There is one stock that is about to skyrocket. This company just had a revenue in the 100 million plus, beat consensus. They also had in-force premium grow 20-30%, which is a big deal for this insurance provider. They're really a marketing insurance company. The ticker is Lemonade, LMND. And what they do is they connect consumers to insurance plans, and they get a little kickback from that. And they do that online with online advertising. So who would have thought basically a marketing company could be valued at such a high market cap, also beating earnings with such a strong earnings reaction. So let's take a look at the stock.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
So here's Lemonade. There's the revenue above the consensus. That net loss was less than expected. And this is the premium growth year on year. It's $1 billion of premium. I believe that's like what they wrote or was written based on their customers they acquired. So if they get, a 20% of that, that would sort of check out as far as what their revenue was. 20% seems a little high, but believable. I mean, these customers are highly, highly profitable insurance customers because they don't churn, right? How often do you switch your insurance? Less often than like your streaming probably, or your, maybe your phone bill you keep for a long time, but you get the idea. So gross profit margin improved as well. And they raised guidance. So that's basically the recipe for success on earnings, where you have the earnings per share being better than expected. It is negative, but better than expected. And then the guidance being raised as well. So solid reaction. And then, as always, wait for the candle to close. There's a level somewhere in here, around 74. Or you can buy above that and then risk $1 to make 10 or more. So that's always the game plan. This is the chart. This stock has gone on a run for sure since April. It's now up almost 200%. And they are one of those startups that survived the post-COVID trough. So solid volume, solid reaction, and solid levels. Now, Lemonade does have some problems, right? Unprofitable. And that's a problem for an advertising company for sure, given that their whole job is to buy customers and make money on that split between the acquisition and handing the customer off to the insurance company. And if they can't do that, it kind of raises some eyebrows. Like, I get that they have costs, but the costs are mainly advertising itself, which is their whole strength, or supposed to be, right? So important to watch it and make sure that switch does flip at some point, because there are a lot of small companies that do what they do. So they have to have some sort of brand. They're trying to become like the Nerd Wallet, right, of insurance. So Nerd Wallet does credit cards, and you type best personal loan, Nerd Wallet shows up. So they do a ton of advertising as well. And then when people search, they also get that brand recognition as well. So I'm not sure people are yet searching and then seeing Lemonade results and then clicking on those Lemonade results, right? Because they trust the Lemonade brand. I think Lemonade is more of like in your face. Here's how you can save money on insurance, pet insurance, for example. Click this now, go through the sequence of web pages, and we're going to attribute the click into that ultimate lead. So where you fill out your information and you get that quote, there's a post back to Lemonade, and they get credit for that customer. So if they can't make that profitable, that's a problem. Now, there's also risks from catastrophic events, sure, all the normal insurance issues. But car insurance, yeah, they are still building out. This is the big one, car insurance. Car insurance is particularly tough because the margin is so low. And you have to be incredibly aggressive to advertising, like saying you're going to get car insurance for like $20. It's like, I'm not sure Lemonade wants to take on that risk. So we'll see what happens with future profitability updates. And if this revenue guidance gets hit, I'm not too worried about the revenue guidance getting hit. Like, that's not that monumental, like, because we know they can just spend more money on ads and then get more people to sign up, right? The really important part is, can this gross profit margin improve such that the margin is good enough that they're actually able to be profitable, right? That's what we're trying to target here. So that's pretty much the story. I mean, I can't even think of big investments that they could have. Like, I get that they have to have staff, but they don't have equipment really. So I'm really at a loss, honestly, for why they're at a loss. If they do become profitable, they could become the Nerd Wallet of tomorrow. But right now, this is definitely a 1 to 3 month hold, not a like multi-year hold. So there's only so much tech that they can invest in as well. So I honestly, guys, after all this like deep dive on Lemonade, I'm highly skeptical, except I really like the chart. So this is one of those situations where you got to trust the chart and the buyers. You know, it's like buying quantum stocks when they're up 80%. So this is the level to risk off of, 75. Buy that, look for 10, 20 bucks, and then look for a big 10% move on that to get a gain. So if you like this idea, hit that like button. If you want a free course on how to buy stocks before they go up, hit that subscribe. I post that in the YouTube post section. And if you want one-on-one help, head over to stockscommunity.com. It's not financial advice.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
All right, a little more Kevin here.
Highest level since March, which saw 350 individual job cut plans. The total for the month was the highest, since 2003, which is more than 20 years. But October itself had the highest total single month in the fourth quarter. So this is specifically referring to the fourth quarter since 2008. So think about this alignment here, okay? Worst total job cuts for October since 2003. That's this chart right here, okay? Ding number one. Ding number two, worst fourth quarter since 2008. And remember, we had even worse unemployment in 2009 after Lehman Brothers collapsed, which is concerning. And then, see, they even say here, over the last decades, companies have shied away from announcing layoffs in the fourth quarter. So it's surprising to see so many in October. But it's not just surprising to see so many in October, it's also surprising to see now the highest level of announcement plans since basically Liberation Day, tariff panic. And we're talking about a lot more. 450 companies to announce layoffs is a 28% increase in layoffs to come since March.
There's the earnings.
So these numbers are bad. Technology, 33,000. Retail, retail, not a surprise that you're not seeing as many job cuts here yet. 2,400, down a little bit from the prior month. So far, though, we're still high on retail layoffs for the total for the year. Services sector, didn't see that many in October. It's actually warehousing that really drove a lot of numbers in October, which suggests, quote, an ongoing overcapacity and automation-driven restructuring. Okay, so I'm going to give you a play, but at this point, I think this play is getting a little expensive. But I think robotics, okay? We've been talking about this in the course member live streams. Symbotic, we know this is a play we've been playing since 20 bucks. It's absolutely been killing it. $4. This is forklift robotics for factories, like actual warehouse automation. There are other opportunities
Ford,
that you can get
BMW,
into
and
robotics, but look at that robotics.
All right, robotics and lithium is where it's at. Looks like they had revenue down over $1 billion. Let's take a look at that. Revenue for the quarter fell to a little over $1 billion. Lowered its capital expenditure forecast. There is one stock that is about to skyrocket. The company mines lithium and they have partnerships with BMW, Ford, and Caterpillar. They just had Q3 earnings, and the capital expenditures are down to about 600 million from over $1.5 billion. So massive decrease in capital expenditures, making the earnings reaction great. Let's look at the chart and why this ticker ALB is such a good buy right now. It's not financial advice.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.
So here is the capital expenditure forecast. So it's lowered significantly, which is a big deal for a mining company. I mean, you can imagine mining is very capital intensive. So this is the chart. If we look at a 5-year chart, we can see not much has gone on that's good. But now we're starting to perk up, and $100 is a very key psychological level. You can't really see through all this stuff, but it's definitely important going back to sort of here, give or take, $10. So this is the current spot. On a granular level, you could probably buy it over this level right here, $98. So risk a buck and then try to get through 100. So when everyone's buying it through 100, you're already in. And if it goes down, you just sell right out. So you're not chasing. There's a reaction. You can see the reaction turned up. This is a very ugly way to look at this chart. So his is a little more elegant, at least. Gosh, this is not what we want to look at here. How about this? 30 day. I don't know what to tell you guys. There's nothing worse than looking at someone else's charts, but there's even worse when that someone else can't display it in a way that's super easy to look at. So we'll see if this makes more sense at a later date, but right now, Thinkorswim Schwab is not displaying this in a very understandable way. Here's a way to look at it that is probably as good as we're going to get. There's the reaction, and you can see from this level, it pretty much held. I mean, it's so illiquid that it's kind of ugly, but as long as you're not trading with more than, say, $10 million or $30 million, this is totally fine. So, for example, right here, this is 100,000. This is a 10-minute chart. This is a $100 stock. So this is basically $10 million transacted per 10 minutes. $1 million a minute means you can click your button and not worry at all about getting in. So all this to say, just because a stock has, under 5 million volume, price matters too. That's where dollar volume comes in. Enough jabbering about liquidity. Almost no one cares about that who's watching this video. It's plenty liquid for you and me. So this is the company. This is Albemarle. I'm not a wordsmith here, but the point is the chart looks great, and most importantly, that capital expenditure forecast decreased, which led to that positive earnings move. I'm pretty sure that's what ChatGPT is saying, and it seems to make sense. So lithium pricing is not great. This is how they've been able to do well, stabilize volumes and reducing costs like we just talked about. And then smaller loss than expected is solid. We can see that on the chart here. The loss was expected to be almost $1, and that's only 20 cents. So that helps, although that's not in and of itself enough. I think this capital reduction thing is the big thing. But again, this might not be a 6 month to 1 year hold if they're not growing as much due to spending less. So this might be like a one-time recognition, kind of like the Meta $15 billion tax hit that tanked their stock. And yeah, if you're like some billion-dollar fund, then maybe you just hold through this, or you don't worry about this, and you're all about the meta growth story. And maybe you bought back, somewhere in here, and you just have to hold through this. We don't, okay? When something like this happens, we get out. So that is the beauty of being nimble. So you can get in here, and you don't have to worry about how those capital expenditures impact Q4 We just have to worry about the next month or so if you like this idea. Basically what they're doing, is they're mining lithium so that electric vehicles can use the lithium, right? So there's some companies that benefit from that. Ford, 5-year agreement to supply lithium for Ford's EV production. That's a lot of lithium. And then BMW, it's for their batteries as well. And Caterpillar as well. So it's pretty cool to think of electric, mining equipment. I don't know if Caterpillar calls it mining equipment or they just call it basically, big trucks. I can't even think of the word for it. Mining trucks, big Tonka trucks. I just sound like an idiot, but you get what's going on. Lithium is a rare, it's not super rare, but it is an earth that's critical for lithium and you need for electric vehicles. And you need companies to do the mining. So that's what ALB is doing. They have significant deals and they have a solid chart as well. So everything is pretty much checking out here. Lithium America is the most volatile of the bunch. This is a kind of almost a penny stock. So I don't think this is interesting to buy after, all this speculation stuff is rolling over. I mean, the rare earth stocks had a little bounce, but I mean, USAR, MP, keep in mind, they just went down a ton. So I don't know if you want to be buying this. That's basically a falling knife. So I think ALB is the right ticker to be looking at, and keep an eye on LAC, but ALB is definitely the juggernaut. So they also do a mix of lithium and other chemicals, so they have a little bit more diversification, whereas Lithium America is clearly like speculation on lithium, which is this. People have been talking about Lithium America on and off since 2020. So it's nice to take a breather and look at one that has a little more of a cleaner move, ALB. So that's the idea. If you like that idea, hit the like button. If you want a free course, how to buy stocks before they go up, hit subscribe. If you want one-on-one help, go to stockcommunity.com.
This is Sam Putnam. This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam.
This is Sam Putnam. This is Sam Putnam.